All right, guys, welcome back to the channel. And in today's video, I want to showcase a complicated option strategy that I unveiled involving TQQQ, which is a NASDAQ triple leverage ETF. And I started it in the autumn of 2021, and I just made some tweaks to it today. So just wanted to showcase that. And as always, guys, this channel is for entertainment. Just because you're watching this isn't necessarily something you should follow. Speak to your financial advisor, so on and so forth. But let's get started on it. So you can see here, scroll down. These are some open option positions I have right now. And you can see here where the cursor is on September 16th, 2021. I sold the June 17th, 2022 85 call, two contracts. Each contract I got $967. So the total proceeds $19.34 and 33 cents for those two contracts. And you can see today it's trading at 6 cents. So my gain is 1922 with a 16,000% gain on it. I actually closed that position out, and I'll get to that in a little bit. But simultaneously, once I received this 1934, I went ahead and bought a put on two other contracts. So to start the position, I had 400 shares in TQQQ, and I wanted to lock in some profit. It was trading, let's say, around 70 or so at the time. We can go historically and get it exactly, but for the sake of argument, let's say it's trading at 70. So I sell the 85 call, take in cash, take in the premium, and I use that premium to buy a put. Now remember, when I buy that put, it enables me to sell at that price. And so I bought the 57.50 put, which, let's say TQQQ crashed and it's trading very low now, I would be able to sell it no matter what at 57.50. Let's say it traded for $5. I would be able to sell it not at $5, but at 57.50. So it's a protective device there. So selling the call, taking the premium, and buying the put. So let me show you. Let me scroll up here. It's in the T's here. So here it is. Use. So there it is right here. TQQQ, June 17th, 2022, 57 put. So, and you see it's on the same day. Now, so this was a purchase. So I took my premium, which was 1937 or so, and I used that 1937 to buy this put 1915. That's what it cost, 1915 in cost. So it's almost a even split there. Lo and behold, TQQQ has cratered essentially. It is trading. We can pull that up. Let me pull it up here on my phone so I don't have to leave that screen. And so lo and behold, that particular put, so right now it's trading at 38.61. So remember, I have the ability here to sell 200 shares at 57.50 for something that's trading at $38. So there's inherent profit there. So the value of the option is therefore worth a decent amount. You can see I paid $19.50, $9.57 for each one. So $19.15 was the cost. But today I can sell it for $36.20 at a profit of $17.04, 88% return. So that's what I did. So what I did is, and I'll show you the next screen. I looked at the positions. I thought, wow, the NASDAQ is really sold off. Let me lock in some profit here and sell to close. I bought to open. So I did the sell to close on these two positions. So we're going to go in here on transactions. So here we go. So you see I sold TQQQ June 17th, 57 put $18, 18.10 basically, and there's two contracts. So you take 1809.33 times 2, 36.18 cash to me today. And what did I do? Okay. So again, this is where I get in the weeds here with some of this option stuff. But so I basically took in $3,600 to my account. And the question is, okay, so with that $3,600, what is it that you want to do with it? Do you want to leave it in cash? That's an option. Do you want to buy vanilla index funds? That's an option. Do you want to buy what I would view as value-oriented positions like Buffett's HP or Manulife with the entire 3,600? Instead, since TQQQ is sold off so tremendously, and it's trading, it was like at 36 at the time, maybe it's, 38 right now or so. I said, well, I wonder what the premium would be if I used that 3,600 and sold the 30 put on TQQQ. So I used the 3,600 for another cash secured put. And so I sold May 27th, so basically a month out. I collected $143 in premium on the 30 put. So I used 3,000 of the 3,600 collected. That cash is set aside in case TQQQ trades at 30 or below. Then I have the cash to fulfill it. And let's say it trades at 29, then I would immediately turn around and sell the 30 call and collect more premium. So what I did then is I took the 143 and I used that premium to buy Manulife, which I've been buying now for the last month or so. It's kind of an undervalued, value-oriented type of play, low price to earnings, high dividend, so on and so forth. Very kind of a Buffett-esque type of stock. Not, it's not Twitter or Netflix or something that's getting a lot of glamour media attention. So then I took that premium, bought that, and then I just closed out the 85 call. And what that does is that frees up the I closed out the position for basically nothing, $12. So if I wanted to then turn around and with those 200 shares reopen another call position to collect more premium, I can do that. I haven't really done anything with that. I just opened that up so that capital isn't locked away there. And then you can see the final thing that happened today was QYLD dividend coming off. So yeah, you can just see this is sort of the action for today. And yeah, I know that's a little involved, and maybe it's some of you got lost in the whole process. But what I want to do is show kind of the power of options, and even in declining market like this, by using options to hedge certain things, you're able to take in income. Able to take in that income today. To be able to continue to accelerate compound interest. Remember, everything I do is to accelerate compound interest. And so obviously you can see a day like this, there's big sell-offs. So you can see here down 521. Yeah, I mean, NASDAQ's down 3.83. Dow's down 2%, 202. S&P is also down. So yeah, I mean, this week, this year has just been, a lot of volatility. But the Dow's been in that 33 to 36,000 range or so. It sells off, then it rallies back to 35,000, 34,000. And then it sells off again, and then it rallies, and then so there's a lot of volatility. And that volatility, you can do certain things with options to take in premium by also reinvesting your dividends. You're just, you're compounding. But yeah, I mean, you can see in this particular account, since let's do the 1 year. Let's do 1 year, and then we'll do year to date. So you can see 1 year it was 601, and today we're like in the 520s. And then year to date, let's look at that. And again, I have multiple accounts. I have my Alpaca, I have my Interactive Brokers. It's about $1 million, $1.1 million, depending on the day. 644. So again, definitely selling off. But this is when when you can really do well by doing nothing, by reinvesting your dividends. If you're doing options, taking your premium, buying value-oriented or undervalued positions, and kind of biding your time. So there you go. Just wanted to do that short video today on that particular option strategy. Any questions on that or comments, feel free to write in. Really appreciate it. Take care, guys. Ciao.